So I've taught this course on climate risk several times now, and every time is different. Every time I learn a new way of explaining what's happening. The part that I'm talking about today, I consider to be the most important part of this course, but it's difficult for me to explain the relevance of what I'm talking about because you may not have the historical perspective of finance that I need you to have so you understand the historical relevance of what's happening in climate-related markets today. So for that, this year I'm going to do something new, something different. I want to talk about the Bay, the Hudson Bay Company. Hudson Bay Company, yes. You may have gone shopping there once or twice. Okay. It's a very interesting company. And what I would like you to do is I would like you to answer a few questions about the Hudson Bay. And I suggest you use ChatGPT or something to answer these questions for me, okay? When was this company created? Do you know? What I want you to... 1670, exactly, 1670. And it was created as, what was Canada in, was it a Canadian company or what kind of company was it?
London.
Yeah, did Canada exist as a country in 1670? Did not. Yes, who created this company? What was the original name of the company?
The Governor and Company of Adventures of England trading into Hudson's Bay.
There you go. That was the actual name of the company. Okay, now what's the name of the company now?
Hudson Bay.
Hudson Bay Company, HBC, right? Good. What was the company's assets when it started?
Sure, but at some point they had a training.
Oh no, at some point, yeah. Well, okay. So we're going to that. Okay. Again, I don't know if you find this painful, this questioning that I'm doing of you, but I want you to understand something very, very important. Okay. Very, very important. So, what was the company's assets? He had one asset, only one asset at the beginning. What was it?
The exclusive rights to Rupert.
Exactly. They had the rights to hunt for fur. If I remember correctly, it's beaver fur, I think. Right? So this company had one asset that was an option, a real option. That's all. They had no buildings, they had no... So there were shareholders in this company. Okay, I actually don't know how many shareholders. Can you ask ChatGPT how many shareholders there were? How many?
18.
18 shareholders. Okay, that's good. I learned something today. So there were 18 shareholders that created a company who had a single asset, which was the right to hunt for fur in a certain area around the Hudson Bay. Right? Okay, great. What if you were offered to, you are now in the year 1670, 1671 maybe, and you're offered to buy shares in that company? How much would you pay? It's a rhetorical question. We don't know how much we would pay. But what would you take into consideration to calculate the price of that stock? The risk. Okay, well, you price the risk. Okay. Well, you need to price more than the risk. You need to price the performance. You need to price the return. You need to understand the value of those rights. Yes? Okay, so you're taking a course on pricing theory. You already started. You had 3 lectures so far. Have you seen how to price the rights to hunt for fur in the Hudson Bay? No, you're not going to see that. Okay, you're not going to see that. Now, fast forward to today. Is the Hudson Bay listed on the stock market?
Yes.
It is listed in the stock market. As a HBC, yeah. What's the price of the stock today? Okay. So what has changed from the year 1670 to today with the Hudson Bay Company? If I ask you the same question, if you're offered to buy the stock today, how much would you pay for the stock? That's the answer, right? It was delisted already, right? So the price that you got, Aldo, is from where? Is it from, it was delisted in what year was it delisted?
2020, I think.
In 2020 was delisted, right?
Yeah.
Yeah, so before it was delisted, let's go to before it was delisted. So let's say that we were in the year 2020 and you want to buy the company, what do? You check the price and you pay for it, right? So what has changed in all those 350 years? What they sell? No. Well, it is true, that has changed, but it has nothing to do with the fact that in 1670, it would have been very difficult to find the price of the Hudson Bay Company. But today it's very easy, it's there, right? What has changed is, first of all, was there a stock market in 1670? When is the stock market? Now we'll have to look at the London Stock Exchange. When was that created? 1801. So that was roughly 100 years later. So let's move 100 years later. Let's say that you want to buy the stock of the Hudson Bay Company in the year 1802. And let's assume that it's already trading in the stock market in 1802. How would you trade it? It's not very different from today. You don't have an iPhone, you can't check the price online, but how does it work when you buy a stock in the year 1802? Well, you go to the exchange. You have a negotiation. And that's what the exchanges did. And then, yes, and you negotiate with the seller or with the exchange? Who do you negotiate with?
The exchange.
With the exchange. With the exchange. Okay? So what has changed between the year 1670 and the year 1802? What has changed? What has changed is that there's an exchange. Before that, you have to negotiate with the people. In the year 1802, you negotiate with the exchange. It became easier to buy and sell stock, right? It's much closer to the way things are now. But now, let me ask you a fundamental question. This is very important. What's the difference between stock trading in 1802, when you had an exchange, and today, 2020, before it was delisted, when we also have an exchange? What's the difference? There's a very important difference. And the difference is that accounting standards were developed. Imagine that you go back to the year 1802 and say, what does this company do? I say, well, we hunt for fur and then we sell it. Okay, that's great. I'm willing to buy some shares in the company. Yes? And then imagine you're going to give an offer for the shares. What information do you have to make an educated guess for the value of the company? How do you buy shares in the year 1800? Okay, let me ask you a different question. Who trades stocks here? You trade stocks? You trade stocks? So raise your hand, raise your hand. Okay, so when you trade a stock, what do you look at to make a decision?
It's gonna generate cash flows.
You look at the company's cash flows. That's what you look at, right? Yes? Okay, good. Anybody else?
Like the financial performance.
Performance. They have financial statements. The financial performance is something that you construct, right? So you would look at the financial statements. So you look at the financial statements, you look at their cash flows. They are in the financial statements. So you're saying the same thing. You look at the financial statements. What do you look at?
I use the technical analysis.
You look technical analysis. What does technical analysis mean?
It's like kind of indicators, MACD, moving average.
Okay, so you ignore the financials of the company.
Yeah.
This could be a company losing millions of dollars a year, but the technical analysis says it's hit the bottom, it's going to rebound, you go and buy it, right? It's okay, we're
Yeah,
just
yeah.
talking.
I mean,
We're
that
not
is-
doing a trade, I just
Yeah,
want to,
that is
I'm
the
teaching a
basic-
class,
yeah.
so, yeah?
I think that is also the fundamental of the algorithm trading, right? Because algorithm trading also look at indicators.
Okay, so,
Yeah.
okay. So you look at indicators,
Yeah.
okay?
And-
And you look at financial statements. Good. Anybody else, what do you look at?
Market sentiment.
Markets, and you look at market sentiment. Okay, very good. That's a very good answer. I'm going to make a comment about that last. Okay, last. Anybody else? What do you look at?
Price multiples. The price multiples.
The price multiple. Explain that. I don't know what price multiple means.
Compare the present price to any per share to other similar.
Okay, so that comes from the financial statements, right? So you're looking at the financial statements, and from there you draw some you you do some analysis of the data which is in the financial statement, right? Yes?
Yes.
Good. What do you do? Yes, you trade stocks too, right?
Yeah, no, I was gonna say P, like look at the P ratio and market spend.
Okay, same thing. You look at, okay, so you all look at, except for him and for him, you all look at financial statements, right? You look at the chart, right? And you make predictions, this graph is going up, or this graph is, that's what you do, right?
Yeah, and also like sentiment can also be transferred to indicators.
I understand. I'm not asking you how you do it, okay? So he looks at sentiment, you look at the geography of the chart,
Yeah,
right?
yeah.
Yes?
Yes.
Okay, good. But most of you, except for two people, you look at the financial statements. When did companies start publishing financial statements? Oh, by the way, I agree. You look at financial statements always, no matter what you do, okay? Even if you look at consumer sentiment, even if you always look at financial, that's a very big deal. Because without financial statements, how can you, right? So I will finish that question later. So when were financial statements introduced? These are important points. I hope you'll understand how important they are a little bit later. But these are important things. I need you to understand these things. I don't need you to have a view of finance which is limited to what you know today. I want you to understand how finance was 300 years ago. That's very relevant to today because today we're going to look into the future. The only way to look into the future is by understanding the past. Well, it's not the only way, but it's one of the ways. Okay? So when were financial statements introduced? When did do you think the Hudson Bay Company did financial statements in the year 1671? You know what a financial statement is, right? Yes? Publicly traded companies release their financial statements how often? Quarterly, yeah. With certainty, quarterly. They release their financial statements quarterly. They are audited once a year. When was it common that companies had to publish financial statements?
1980s.
What?
80s, 1980s.
1980s. Oh, wow. Okay. No,
I was gonna say it's mandated by the SEC in 1934.
1934. Exactly. There you go. 1934. Right? Okay. So financial statements, they were, what happens? You mentioned the Securities and Exchange Commission, the SEC, right? This is part of the Advisors Act of 1933, and then 1934 was a revised version. What happens if you lie in your financial statements? You probably go to jail.
Oh,
And a fine too, by the way, yes. It's one of the most illegal acts you can commit in the United States. I think this is far worse than murder.
so how about like a Chinese company fake some things in U.S. stock market?
Say that again?
I mean, a Chinese company like
A Chinese company that fakes numbers,
yes,
and the company is in the United States.
like maybe no.
No, I'm talking about we're talking about the SEC. You mentioned the SEC. Very important,
Yeah.
okay? Because the United States has some of the most advanced regulatory regimes for financial disclosure of publicly traded companies, right? I don't know about China. I should know. I'm very curious to learn what happens if a Chinese company lies. But if a US company lies in the financial statements, like the police shows up with big buses and everybody goes to jail. The coffee maker goes to jail. Everybody goes to jail. Yeah? It's a very big deal. You don't mess with that. And that is a consequence of the Investors Advisors Act of 1933. The Investors Advisors Act of 1933 was a consequence of what? People who've taken my course know this. Lucas knows this. That was a consequence of the market crash of 1929. Have you heard of the market crash of 1929? Market crash of 1929 is still today one of the events that had the biggest impact in finance because of the regulation it gave rise to. So that's why today financial statements are trusted. Okay? They are interpreted also. People interpret them, but they're trusted. If they say that they made $16,233 in cash in sales, that number is true. You trust them. And they've been around for about 100 years. More than 100 years ago, financial statements were done. When was accounting introduced for the first time? When was accounting introduced for the first time? And who did it? What does ChatGPT say about that?
1494. ChatGPT said that.
1494.
Yeah.
Accounting. Okay, I don't know what your prompt was, but accounting was developed for the first time by ancient Egypt about 6,000 years ago. It doesn't matter. That's not the answer I was. That's okay. That's okay. Accounting is very old, but trustworthy accounting is very new. It's about 100 years old. So prior to that, if you're going to buy a stock, say Hudson Bay stock in the year 1801, when it's already trading in the London stock market, you had almost nothing to guide your decision making. Okay, so let's compare now how you, those of you who buy and sell stocks, compare now how you buy and sell stocks today and how you bought and sold stocks 100 years ago, before accounting standards were done. What's the difference? The difference is data. The difference is information and your ability to process that information. Okay? So in a certain sense, I want to say that technology has been a companion of the stock trader, because it has made what was almost an impossible thing to do 200 years ago to something that people now do in a trustworthy manner and fairly fast, very quickly. I don't know if you got it. I'm trying to get you to understand the historical evolution of all of this. Yes? Yes? Did you get it? It's a very big deal. Okay, let me ask you another question. How many of you like derivative trading and derivatives and this and that? Many people come to MMF because they love derivatives. So raise your hand. Don't be ashamed of that. This is a good thing. This is something to be proud of.
Option?
What?
Is option counted?
Yes. Derivatives, options, futures and forwards and all of that. There you go. You like all of it. Okay, great. Oh, not many people. The rest of you, why did you come to MMF, buddy? I want to know. Why did you come here? Why are you here? You know, you waiting for lunch or something? What drove you to MMF? Well, that would be something I would like to. When we go for lunch, you tell me, okay? I really want to know why you came to MMF. Okay, so, all right. When were derivatives markets started? I don't know what ChatGPT will say to that question, because the first derivative is very old. It's been around more than 2,000 years, but that's really not my question. My question is, when did volume in derivatives really make it like an attractive business, something that you want to be part of because there's money to be made? Yes?
What was stage or just in the United States?
Say that again?
On a global stage or just in the United States?
Actually, the United States was the first one to do it, so it doesn't matter. The answer will be the same.
The 70s?
The 70s. There you go. Okay? The 70s. And again, I like to talk about this in my courses because I want people to understand these things. So like Lucas have taken my course, he knows the answer to this. So don't say anything, Lucas, let the others, okay. The 70s. Why the 70s? What happened in the 70s that made derivatives?
The CBOE was established.
The what?
The CBOE. the
Okay,
options.
so the CBOE was established, but the CBOE was established because derivatives had to be traded, right? And things happened that made derivatives attractive, right? Okay, so I want you to understand one thing. Why did people buy derivatives? That's a question I want to ask. Why did people buy derivatives in the 70s? Why? What happened in the 70s that led people buy? Why do people buy derivatives today? Because it's fun?
For insurance?
Insurance. Okay, yeah, so people buy derivatives for insurance, right? Okay, so people did not need insurance in the 50s, they needed insurance in the 70s. Is that why they started in the 70s? Or why did derivatives start in the 70s? Sam, I'm talking to you because you seem to be very engaged. So,
ChatGPT says stagflation.
stagflation, yes.
Oil crisis as well.
Exactly, that's exactly right. Have you heard of the U.S.-Iran oil war. Know what's going on now? What's going on? Have you heard of that? The oil embargo of Iran. Have you heard of that? No. Okay, you need to brush up on your history. It's very, very important. Okay, you need to put things into place. And that's what I want to do now, because I'm about to show you something that will change the course of history. I'm convinced, but it hasn't happened yet. It's about to happen, and I need you to appreciate that. That's why I'm having this weird conversation with you and ChatGPT. Okay, it's very important. I need you to understand the evolution of this. So in the 70s, that's right. Have you heard of Silicon Valley Bank? What happened to them?
Broke.
Yeah. Have you heard of Credit Suisse? What happened to them? Yeah. Have you heard of Salomon Brothers?
Broke.
Have you heard of Bear Stearns? Then what happened to these banks? Okay, broke, right? In that period, it's a bit earlier, in the 50s, leading to that, right? What is your guess about the number of bank failures in the United States during those years? So in 2022, we had 2 bank failures, 2 big ones, right? Silicon Valley Bank and Credit Suisse. Well, Silicon Valley Bank was a real failure. Credit Suisse was bought by UBS, but it's considered to be a failure. So we had 2 that year. In 2008, one of the worst years in a long time, we had 2 big bank failures, Lehman Brothers and Bear Stearns, right? In 2008, we had 2 big ones, yes? Okay. So a lot, 2 in 2008, 2 in 2022, an occasional one here and there. In the period leading to the 70s, how many bank failures were there in the United States per year?
Guessing not a lot.
Huh?
Not a lot.
6. 6 every year. So it was, from the point of view of bank failures, it was 3 times worse than 2008 or 3 times worse than 2022. Actually, 23 if you take into account when the actual default happened of Silicon Valley Bank. But you understand what I'm saying? That's a very big deal. Can you imagine that? What was the inflation? Do you know the interest rates in 1982? Interest rates were 11%. Inflation was extremely high and growth was negative. We haven't seen numbers like that for a long time. The macroeconomics of that period were horrible. Horrible, much worse than they are now. That's where derivatives markets existed. That's where they were created. You said insurance, right? Yes, it was for insurance. Insurance against what? Insurance against all that mess that was happening to financial markets. Some people think derivatives were traded because they have nice formulas. No, the formulas came later. The need for derivatives was there because the financial markets were a big mess. And it so happened that mathematics became very useful in the trading of these very complicated instruments. And that's why MMF exists, and I would like to think that's why you are here. So you are here because of something that happened in the 70s. Am I right? Am I right? I'm not talking about your parents being married. That's not what I'm talking about. Okay? You're at MMF because of something that happened in the 70s. And we're still feeling the effects of that. Now, does it mean that the events that led to why you're here, does it mean that they're going to continue to be there the way they were? Do you think the derivatives markets will continue to be in the future as they were in the last 2 decades? Very likely not. Very likely not. So what I have for you today is a new security. Actually, it's been declared to be a security by the SEC very recently. It's a new security that the SEC has said this is at the same level as derivatives were in the 70s. You understand the historical moment of that statement? No, I don't think you get it. So I'm going to try again. Okay, I need you to understand this. I don't think you understand. What was the derivative that first picked up like a lot of volume. It was like billions and billions of trades of that particular derivative. Which one was it?
Interest rate swap.
Sorry?
Interest rate swap.
Swaps. So swaps was perhaps the first derivative that took up in big volumes, right? Now you know a lot about swaps now, do you? Yes? You know about swaps, yes. Okay. Do you think swaps are interesting? Okay, why are they interesting?
Because for interest rate swap, we can change float interest rate to fixed interest rate. To
Okay, that's a very good answer, but I'll give you a different answer. They are interesting because they trade in the billions. Which one do you prefer as an answer, yours or mine? Don't say mine, just tell me the truth. You'd like yours, right? Well, I like mine. I like mine. I like to think that swaps are interesting because of the billions and billions of dollars traded in them. You think they're interesting because they do something which is very interesting, which is that they can take this uncertainty into certainty, right? I'm saying, well, that's very nice, but if no one cares, then they're not interesting. So for me, what matters about swaps is that billions and billions were traded. Yes? So just, you have two perspectives, okay? And you may have a different one. Anybody has a different perspective? What's your favorite derivative? Anybody has a favorite derivative? You don't have a favorite derivative? So tell me.
Futures,
Futures. Okay, what do you like futures?
they're pretty straightforward.
They're very straightforward. Okay, so you like simplicity? Yes? Okay. Well, I think futures are very, very interesting. Very, very interesting. Perhaps more than swaps. Okay? But my argument would be they're very interesting because what's the volume of futures? Can someone ask ChatGPT what's the daily volume of futures trades today?
Annually is 29.1 billion.
Oh, no, I don't believe that number.
Okay. Yeah, maybe.
Does
I'm
that
wrong.
ChatGPT tell you that? No, I don't believe that number.
So like 10 million to 20 million daily, like 10 to 20 million.
With M or B?
Oh, M.
10 million daily? No, I don't believe that number. Is that ChatGPT?
That's not GPT.
Yeah, yeah.
No,
mine is
okay, then, okay, well, there you go. Okay, let's frame, what?
700 million daily.
I believe that number.
Oh, okay.
That number I believe.
So,
I believe that number, okay? And if now I'm talking to Sam here, I would say, that's the reason I think they are really interesting, right? And there's one thing that I like to tell all students when you have to make life choices in your career. You can choose to follow the equations, you can choose to follow the money. Sometimes they are the same, sometimes they are not the same. If you choose to follow the money, you will probably make a lot of money. If you choose to follow the equation, you will probably make a lot of equations. Okay? Just be aware of those choices. If someone told you that they are the same, no, they're not the same. They're not the same. Okay? All right, so now I'm going to talk about now I can start my class. I think we're in the right mindset. This looks like weird, maybe. But I want you to think about what we're doing from a point of view of historical. I'm trying to, I have no idea what the world would be like for you when you're halfway through your career. I have no idea. No one knows, you don't know. But it's important to have some scenarios as to what might happen because you need to be ready for that. And it'll be a big mistake to think that your career is going to be related to the things that we observe now. No. Again, I'm almost certain that your career is going to be dependent on things that today we don't observe. Today they don't even exist. So you need to be very forward thinking about your career. And that's what this course is here. This course was introduced a year ago, and it's in preparation for the things that might come. So last week I gave you some background. We talked about risk and the diversifiable risks and not, and risk premium, this and that. Today, I want to tell you about the actual securities which are being developed today, which would be the similar of the swaps or the forwards of the 70s. And that's how I want you to look at what we're doing now. These things, they're traded in very small volumes, I think we're at the cusp of these type of securities being the drivers for financial markets for the future. Maybe yes, maybe no. And that's why this course is here. You understand now? I hope. All right, so I want to start with the business case. Usually I do it the other way around. I tell you this and that, and then I give you the business case. I'm going to try a different approach now. I'm going to start with the business case. This is a business case. It's called the Nyaliga Fire Project. And it has to do with a corporation that was set up in Australia, in a part of Australia called Eastern Kimberley. Anybody knows Australia here? No? I've never been there. It's one of the places I've never been. Okay, so what this corporation does, is they do controlled savanna burning in the early dry season, which is March to July of Australian time. Don't forget, Australia has the opposite seasons than we do here. So March to July, that would be the beginning of the fall. Okay? And that's the early dry season. So, some facts about the savanna. Savanna has wildfires. They occur naturally. By the way, in Canada, we have wildfires too. In fact, we were in the news last year about our fires, right? And actually this year too. We have a lot of that. But I'm not talking about the fires in Canada. I'm talking about the fires in Australia, and you will see why. Because these fires in Australia have become securities, and the ones in Canada are not securities yet. So you can think of this as the Hudson Bay in the year 1670. That's what I'm talking about today. These fires have become securities. If you don't manage these wildfires, this is well known, everybody knows this. If you don't manage these wildfires, they can burn very intensely at scale and over very long periods of time. They are vicious if they happen when during the dry season. They are vicious. Okay? Are you following me? Good. So if they happen between August and December, that's the dry season, now our perspective that they produce a lot more greenhouse gases than fires that happen during colder periods. Yes? It's plausible, right? We're not going to be experts on this. We're just reading these facts. And so in 2007, a company was created that applied for Emission Reduction Fund, ERF, in 2017. And the argument was that they were going to do something that was going to reduce carbon emissions by doing controlled savanna fires in the wet season. You understand? So you have a company. This is not to look for, not to hunt for fur in the Hudson Bay, which I'm sure was a very weird thing in the 17th century, right? This company is going to be set up to do controlled savanna fires in the wet season in Australia. How can you make money doing that? That's what I want you to understand today. I want you to understand the value of a company whose job is to burn the savanna. I repeat, I want you to understand the value of a company whose mission is to burn the savanna. That's what we're doing today. And let me preface that by saying that this thing that you're seeing here was declared by the Securities and Exchange Commission a derivative just a few weeks ago. This is a derivative. Is it going to be like swaps and futures? I don't know. Could be bigger, could be, I don't know. I really don't know. But I want you to witness it. And we're going to look at this very precise case. In this case, I have the advantage that I have a lot of documentation. By the way, the fires we had in Canada have not, to my knowledge, yet become a security. But this has become a security. Just like the stock issued in the year 1670 to 18 people in England because they thought they were going to go to Canada and hunt beavers for fur. Oh, I don't know if it became clear, but that was one of the first companies that traded stock. The Hudson Bay Company is one of the first companies that traded stock. So the stock trading that you do now, you can trace it back to 1670 for that company. Yes? That's the historical relevance of the Bay. So that's what we're doing here. It's a bit of science fiction. I really don't know if these things will grow or not. But understanding history and knowing that the SEC has declared this to be a derivative, there's a chance. Okay? That's why we are here today. That's why we are here today. So what they do is they generate something called carbon credits, which you can turn for cash, just like any other derivative. A carbon credit is something you can turn into cash. And my purpose today is to explain to you how. It's a very interesting case. I'd like to mention some of the other things that have nothing to do with finance. For the people there, and this has additional benefits. What they do, I mean, I think I'll explain in some detail what they do, but by having these fires, which are controlled, they can decide somehow what is going to burn and when, as opposed to just having a random event where everything is burned, right? So for them, it's important it protects their sacred places because they have control over the fires. It makes areas for food gathering and hunting. That's another side effect of what they're doing. Yeah? They don't get paid for this. They get paid for the emission reduction. They don't get paid for this, but these are additional benefits. And it looks after their food resources, culture, and way of living. They call it right way burning. That's what they call it. Okay? Again, they don't get paid for this. This is not part of the security. This is part of their motivation for doing that. The security that I'm talking about today, this new derivative, is only because of their greenhouse emissions reduction. I have a movie here. I don't know if it's of interest. This is just it shows the fires around the world. Okay, which it kind of has some of them. So these things happen naturally. Fires occur naturally. And so the results, and this is why they get paid for. They get paid for this. And I want to show you how they get paid. That's the interesting part. Because we're going to see 300 years of history in a single document today. So compared to before they got the money, the amount of their country burned has reduced by 1/3. They don't get paid for this. This is just good. The area burned late in the season has decreased by 2/3. They don't get paid for this. This is not part of the derivative. The annual emissions have reduced against baseline averages by over 40% on average. They get paid for this. A baseline in carbon trading is the emissions that you are supposed to have or that you normally have. It's called a baseline. You can be below baseline, then you get paid, or you can be above baseline. And if you're above baseline, you will typically have to pay. And the difficulty in these trades is to calculate the baseline. That's the difficulty. And I want to show you how that is done. It's one of the most complicated derivative pricing exercises you have ever seen. I'm going to show you today. So they earn carbon credits. This is what is a derivative declared by the SEC a few weeks ago, and now they sell them to the Australian government or to businesses. Once you have the credit, you have the right to go to the government and they say, I got these credits, pay me for them. I say, okay, I'll pay you. And they have a market price, just like a stock. Or you can say, you know what, I can get a better deal if I sell them to Shell. Shell will pay me more money than the government, so I sell them to Shell. It's a market. You sell them to whoever pays you more. Right? You understand what I'm talking about? We're witnessing the beginning of a new market. That's what I want you to understand. That's what we're doing. Okay? Now, they don't get paid for this either, but the result is that the trees are better, the grass and the wildlife are coming back. They don't get paid for this. Yes?
Yeah, I got a question.
Yes.
How do they measure the carbon credit?
I want to show you.
Okay.
Well, that's what I'm doing today. That's all I'm doing today. Okay? I find it extremely interesting and extremely difficult. Okay? So, well, so now this is about the company. A company was created just to collect this. Okay? And they also tell us that when I say they, I'll show you where I'm getting this information from. Okay? So they use the proceeds of this to run their fire management project. This is very important. That means that the fire management project has to come at a cheaper price than the credit you're going to earn. Right? But these are two amounts that you actually don't know ahead of time. So there's some risk to be taken here. You think the cost of running this company is going to, I'm making this up, $1 million a year. You can run this company with $1 million a year, and you can collect $1.5 million of carbon credits. But no one knows that for sure. Like the people in the Hudson Bay Company, they had some expenses. What were the expenses of the Hudson Bay Company in 1670? They had to hire people, send them all the way to Canada, pay for their expenses, their living expenses, their food, their transportation, hunt for beaver, kill them, skin them, dry the skin. All of that has costs. And they were hoping that when they get it all back into England, their market was England. Canada was, the local people had no interest in that fur. Okay, maybe they're interested in the meat, but not in the fur. Then we send it back to England that they were going to make more money. But that's not a guarantee like every company. You know, company is born with 100% success guaranteed, right? There's some risk taking, and that's the risk that they're taking here. Understand? Okay, we're witnessing the beginning of something that did not exist. Okay. And they also use that to provide fire training opportunities to people and other things, okay? So let me just go through that. It has good social impact, and this will become relevant. Usually I talk about this after I talk about ESG. That's where these things matter, but I haven't talked about ESG now, so. Well, okay, so let me focus a little bit on the social impact, okay? And these are quotes from them, from the people who actually live there. Again, this has nothing to do with the company, nothing to do with the derivative. And this is another quote from them. So the fact sheet is the good stuff that they get from here. They get diversified revenue, they get cultural benefits, they get farm benefits, and they get property protection. But let me go into the actual question you asked. How is this calculated? So to do that, I want to show you a document. Sorry, something is wrong here. Oh, so it looks like the internet connection is very slow. I hope Lucas and Yanis are following this. All right, I don't know. I'm following it on my iPad, and I see that it's almost a minute delay. Okay, So this is the main thing I want to show you. Okay, so let's see. The people on Zoom cannot see this. I'm gonna have to share my whole screen. Okay, stay right there. There you go. So this is the Federal Register of Legislation of the Government of Australia. There's a certain register, very similar to the stock exchange. Very, very similar. And this project continues to have, apparently this is something which does not exist anymore. This program has been probably ended. I suspect these are carbon credits that probably are only good for 5 years. After 5 years, you don't get the credits anymore. So this company may exist and they may still have other businesses, but they don't get the carbon credit. So this derivative has expired, so to speak. Okay? I suspect it has expired because it says no longer in force, but I don't know that for a fact. I suspect this derivative has expired. But the interesting part is this. There's a document here. There's a document which is called the legislative instrument. Okay. Have you ever seen a swap? You know what a swap is, right? Have you ever seen a swap contract? You've never seen a swap contract. You've seen a swap contract?
Yeah.
Yeah? Okay. Can you tell us a bit of what that swap was?
So swapping the interest rate on listed equity and the T6 kind of.
Okay. So swaps, when they were first introduced, they were done as contracts. You have to go and you want to do a swap. How long does it take to do a swap today? You want to do a swap, how long does it take? A few minutes. Yeah? Okay. When the first swap was done in the 70s, how long did it take to do these swaps? They were contracts. To send them back and forth, you highlight your, okay, black line to move, right? And then you sign it. They're not done like that now. Do you know what ISDA is? ISDA? ISDA. You know what ISDA? What is ISDA?
It's like an agreement between
Okay. Can you check with ChatGPT what ISDA stands for?
It's the International Swaps and Derivatives.
There you go. Okay. So when was that created?
$92.
1992. Okay, so that means that before 92, swaps had to be traded with a contract. There was a contract that says this, and what about this, and there's a termination clause, and this and that. After 1992, there was a chapter in the ISDA agreement that says, oh, swaps are always like this. You specify this, and this happens. Right? And now you can trade them quickly because of that. ISDA. Swap is an ISDA agreement. If you want to do a non-ISDA agreement, good luck. You need a team of lawyers here, a team of lawyers there, and to agree. But if it's an ISDA agreement, it's very fast. So this thing is not there yet. This is a derivative that doesn't have an ISDA template yet. It may have it, it may not have it. I suspect it will. I suspect it will. But look at the complexity of this. This is what I want you to understand. I'm going to sit for this. This is best done when I'm sitting because I'm going to become an accountant now. Okay? Yeah, I want to become an accountant. Just watch. Wow. Just watch. This is very interesting. Okay, So carbon credits, farming initiative, emissions abatement through savanna fire management, methodology determination 2015. This is a math class now. This document is a math class. All right, so it's done by Greg Hunt, a Minister for the Environment, blah, blah, blah. The date is March 25th, 2015. It looks very much like a contract, doesn't it? And it has some table of contents even. Can you see you see the indicator here for the cursor moving? See that? Does that give you an idea how big this document is? It gives you an idea about this document. Okay, these are section, division, schedule, blah, 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 part 1 preliminary, blah, 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 definitions, act, baseline period, calendar year, CO2e means, blah, blah. You see that? It has definitions like a contract. Swaps don't have that now. They had it before, but not after ISDA was created in 1992. Understand? Okay, I want you to draw the analogies between this and the securities markets that already exist. And that when you came to MMF, everybody knows that you just take them for granted because they are there. You cannot take this for granted. These are beginning to happen now. They define what late dry season means. They define what low rainfall zone is and all of those things. You see that? Great, let's continue. They define years since last burnt value. See section 52. See that? See that? Okay. Meaning of high rainfall, meaning of early dry season. This is a contract. They leave nothing undefined. It's a good contract. Okay, so project requirement. That's okay. This is good. I'm going to go over this. It's very interesting to read this document. I encourage you to do it one day. Okay? This Sunday afternoons, you have nothing to do. You know, you're at home, you know.
Just go through the contract.
Just go through the contract. It's a good exercise for a Sunday afternoon, don't you think?
Absolutely.
You're going to do that, right?
Yeah.
Yeah, exactly. Good. All right. So, part 4, net abatement amount. So, there's a paragraph here and then talks about some stuff. We're not particularly interested, but for the first time we start to see some mathematical symbols here. You see that? See the mathematical symbols there? See that? E sub F, A, Y, I, J. That looks familiar. You know, most people, when they see this, they say, oh, what is that? And their eyes like cross over. But for you, they're like, oh, I'm in business. Where's the definition of that? Right? Are you like that? I don't know. Okay, so let me continue. Now, overview of gases accounting for in abatement calculations. Oh my God, calculations. And there's 2, methane and nitrous oxide. And then I have carbon dioxide. These are familiar. We talked about this last week, right? Good. All right. So type 2, vegetable fuel type map. My God, what is this? Requirements to create vegetation fuel. And they look at all of this. Look at all of that. The project proponent must assign to each pixel a code as follows. Are you reading that? Are you reading that? Where is this making a reference to? Pixel. This is so interesting. This is so interesting. Okay, I don't know what you think about this, but I find this to be, but the punchline is going to be in a few minutes. All right, so I continue. Vegetation class, these were defined earlier. Okay, vegetation fuel type code. I have fuel type codes, right? And then vegetation fuel type name. Okay, so this is more definitions. These are variables, right? Validation survey. To validate a vegetation fuel type, the project proponent must conduct a survey with a set of waypoints that satisfies this section. What does that mean? That means they're going to have to hire consultants to actually do all of that stuff. So this is what KPMG does, or Pricewaterhouse. That's what they do. How is this different from when very likely the Hudson Bay Company had financial statements done for the first time? How is this different? This is different because it is far more complicated. Someone has to go into the savannah and actually measure how tall the grass is. The financial statements that led to the first financial statements of the Hudson Bay Company, they didn't have to go and measure, how long the beavers were, for example, or something like that, right? But this is part of the cash flows you're going to get. Just wait. Oh, this is so interesting. All right, now validation. There you go. I start to see some numbers now, and I see my first formula. Okay. Actually, I see a formula looks much more familiar. It's a summation of variables with lots of sub-indices. You see that? So A is the carbon dioxide equivalent net abatement amount for the project in relation to a reporting period in tons of CO2. These are variable definitions, just like when you do a swap, right? This is the interest rate, annually compounded, this and that, right? Obtained from Bloomberg at 3 p.m. on a Friday. It's the same. See that? Okay. Calculation of adjusted net amount project abatement. Outline. There's an outline. And there's the calculation. Conditions. This start to look like Python code now. See that? See that? You can program this in Python, could you? Annual fossil fuel emissions. Why is this here? Because this is gonna turn into dollars. This is how you're going to calculate the value of this derivative. See that? Now I could continue, but I think I've seen enough. Now it gets to be heavier and heavier on the math, right? Is this math or is this programming? Or is this coding? What is this? It's a mix of all of those things, right? So this is how you calculate the payout. This whole document turns into money. Just like a swap did before we had ISDA swaps in 1992. And this has been declared a derivative by the Securities and Exchange Commission. Let me ask you a question. And this is a question about science fiction, so your opinion is as good as mine. How long do you think before a document like this will be read, understood, and interpreted by a ChatGPT?
Half minutes?
Hmm?
You mean
How
long?
sorry. Okay, what I meant is this. Right now, this document is done by humans. Okay? It's actually signed by the Minister of the Environment of Australia. And then it becomes a legal document, which then people, operations start to do their thing, and some accountant and audit, maybe Pricewaterhouse, probably KPMG, goes there, and then they send a consultant to go and check that everything here is, they go to the field with their boots, and then they go to the document, and they come up with a number. That's how these things are done today, right? The use of technology is minimal right now. And my question to you is how long before all of these things could be automated? When you have your drones, they fly over this, they measure all of the variables that we saw there, how tall the grass is, thickness, and this and that. And then they give you a calculation implemented in Python. A large language model reads all of this and produces the report. This is what's going to happen. I'm going to guess 2-3 years. We just need enough volume. When there's volume, this will happen. And now, when that happens, then you can start to trade these derivatives just as fast as you trade swaps. Right? The technology is missing. You just need these volumes to go up before they become as big a deal as swaps and futures were in the 70s. You understand? KPMG has announced they're going to hire 100,000 people worldwide to do these kinds of things. I don't know if you want to be one of those people. I would love for you to be one of those people. But better yet, I would like for one of you to create a company that makes it irrelevant to hire people to do this. So KPMG can fire all those 100,000 people. Yes? Understand what I'm saying? You can do that. You can do that. You can do that. Okay. So this is the derivative that I wanted to show you. And I want you to understand this in the right historical context. I have no idea. Look, this could disappear in 3 years, or this could become the swaps and the futures of the 70s. But what we know is that these are far more complicated than forwards and futures or swaps. Look at the number of variables in a project like this. And, all right, so this thing that we are seeing here, okay, so this thing we're seeing here is what's called a carbon credit. And you just saw a carbon credit transaction. This is it, okay? This is the new derivative. There are more things here. I have the, people in Zoom cannot see this. Let me share this in Zoom. There are more things here. There's a project register. This link does not work anymore because this has been delisted. But on my website, you have the link to the Emission Reduction Fund of the Government of Australia. And the next Sunday afternoon that you're bored, my advice is go there and just go through the website. It's fantastic. This is one of the, in my opinion, one of the most open, organized, regulated carbon markets in the world. This is a market. It's a regulated market. That's why every single project is listed there. The methodology is listed there. The amount of money paid is listed there. The price of CO2, ton of CO2 is listed there, and everything is completely open and a lot of information. And if you're really bored on that Sunday, you want to write your own large language model to go through the whole website, read it and understand it, then you have a very valuable company, because that's what some people are trying to do now. And then if someone says, I have this project, I'm going to do a Savannah Fire project, so it's worth $1 million, and you can calculate that right there with your app. See that? And then that derivatives market is yours, because no one can do this right now. But you can do it. If anybody's interested, you let me know, okay? I know some of the people doing this business, and then we can do some business. And then you can create your own company. I'll help you. This is happening, okay? These things I'm telling you, these things are happening. I don't. Okay, I don't. All right. So, so now I need to talk about the business impact of climate risk. No, I'm not going to do that. I'm going to stop class now. Okay? Yes, I'm going to stop class now. Yeah. Yeah. I need you to reflect on this. Like I said, this is science fiction. I don't know where the things are going, but I have a hunch that this is going to be a big deal. And I think it's going to be a big deal in Canada, not because we have fires here, but because we have very smart investors here. And there's a chance that what investors are doing now, they're going to these projects and they say, no, you know what? No. I do the project and I collect the carbon credits. Because there is a belief that carbon credits right now are too cheap. They are underpriced. The value of a carbon trade right now depends on where you trade, is between $10 to $30 a ton. $10 to $30 a ton. And some people think it's going to multiply by 5. So that's why many investors are going there. Because if it's valued at 10 and it's going to go to 50, they want in now. Because the costs of doing these companies is fixed. That's not going to increase. But the value of your carbon credits is going to go up. And it's going to go up very likely towards the year 2030. Because a lot of countries have these neutrality objectives that we've talked about by the year 2030. And because these are markets which are regulated by governments, what they will probably do is they will increase the price of CO2. The governments will do that. That means if you hold carbon credits, that's a winning trade. And if you are on the emission side, then you're going to have to change your processes to lower the emissions because they're going to become very, very expensive for you. And that's where these projects are beginning to be a very big deal. Okay, do you understand this? Do you understand? And you know that I have no crystal ball. I don't know if this is going to be true or not. I have no way of telling. But to me, this is like the swap market in the 70s. And all countries are in favor of this, right? You hear in the news this and that, but at the end of the day, everybody's in favor of this. And if there's money to be made, all the financial companies will be there. That was in the statement that we saw by Jamie Dimon last week. That's what he was talking about. And Victor Dodig was saying the same thing. Barbara Svan, who's on the investor side, he was saying something different. He was talking about the opportunities of investing here. Has any one of you, when you buy an airline ticket, have you actually offset your carbon credits? No? You know you can do that when you go to a website, Air Canada, for example. You can buy a ticket and then you can offset your carbon credits. No, I do it all the time. I offset all my travel. It costs, yes?
Shouldn't be included in the ticket price?
In the what?
Shouldn't be included in the ticket price?
In the ticket price.
So why should
It's optional. It's optional. That's where I'm going with this. It's in the voluntary market. So I participate in the voluntary market. But you don't have to. The voluntary market is many companies. Shell is, for example, one made an announcement that they're gonna buy, I think it's more than $1 billion for carbon credits. They're gonna do it, right? And then they go around and say, who wants to sell their credits to me? And then you have, that's a voluntary market, and it's a market which is bilateral. It's like the forward contracts. But then you have the regulated market, which is like the futures contract with an exchange, and the exchange right now is government agencies. This thing we saw is a regulated, centralized, government monitored trade. Okay? It's the equivalent of a futures contract, not a forward. A forward is the voluntary carbon market. And I want to talk about this because let me ask you a question. When you trade a stock, what's the commission when you trade a stock?
Usually there are direct commission fees, but there is also the fee of risk spread.
Well, no, but the commission.
Like,
When you buy a stock or sell stock on,
usually it's a percentage of the amount that you are.
what percentage?
0.05% sometimes. It depends on the stock.
It depends on the stock, exactly. Okay. Do you know the percentage? Do you know the commission of a carbon trade? 50%.
15.
50.
Oh, 50%.
50.
Commission fee.
Commission fee.
Oh, that's a lot.
That's a lot. It's the biggest commission I've ever seen of any financial market. So if you want to be a carbon broker, and I know some carbon brokers, that sounds like a good business, no? 50%. And this is exactly it. So this is a picture of the most profitable market that exists anywhere. The brokerage fee 50%. Why do you charge so much? Because there's a lot of work. Well, first of all, you charge so much because the buyer does not know the seller. This is a very small community right now. Of course, price will go down once they know each other, right? But right now, they don't do that. That would be my recommendation for LinkedIn. They should get into this business. They will make a lot more money acting as the broker for carbon trades, but they won't listen to me. So the way you participate in this is you have emitters and you have companies that capture CO2. What you need to have is a way for them to know each other. You need to validate what you're doing. When I buy my carbon offset on my Air Canada flights, I buy it from a company whose job is to validate that the $10 I pay or the $15 I pay is never more than 25, that they're actually, like we saw earlier in that document, they said there's a process that says that indeed, if I consume, say, 1 ton of CO2, that indeed a project has created that 1 ton of capture, right? And that's why they are paid for that. They have to do that, and they do that with very similar methodology as the one that we saw in that document that we saw here today. So the upstream part of the market is projects that issue carbon credits. For example, cook stoves is a very popular small capture project that you have now, especially in Africa. Okay, but it could be other things. And then each of these has very specific characteristics which have to be defined, and they're part of the trade. You need to know the delivery date and the year they were created, like what we saw in the trade that we saw earlier, right? Then these things are typically bundled because they are small, and the brokers, what they do is they bundle these trades. In the case of Air Canada, they get all of the Air Canada trades. I am one of the traders of that because I buy credits, I give them money. Someone gets all of them and then sells them wholesale to other people. Shell, for example, may buy some of those because it's been verified that these projects have lowered the emissions with respect to the baseline, which is how these markets work. Okay? Airlines, for example, are part of one of them. There are at least two exchanges for these types of trades in New York and in Singapore. Okay? But like I told you, this I think we're at the very early stages of this. This is probably going to go up. And who knows what percentage, how many of you will actually be dealing with this, but I think many of you will be dealing with that, okay? Okay, now I do stop now, I show you this thing. I'll tell you more about this next week. Next week is online, only online.